Okay, it's 8:33. I'd like to call the March 10, 2023 meeting of the SDCERS Board of Administration to order. Rosie, do we have a quorum?
Yes, Mr. President, we do have a quorum with all members present.
Thank you very much. Okay, once again, reminding everybody when voting on an action item, please use the board voting system and record your moving a motion, providing a second on a motion, and for recording your vote. So we're shifting into that. Everybody should be familiar with that. Before we move on to the agenda, please let me make an announcement to recognize Charlie once again. Today is Charlie's final meeting serving as the SDCERS board member. While he was elected twice by the SDCERS retirees to serve, he is always known to be a champion of the trust in keeping all members' interests in mind. Charlie, your service as our Disability Committee Chair has been exemplary, and we've been very fortunate to have your leadership, mentoring, history lessons, and wisdom. You are one of the few board members who has actually served both as an active member and a retiree member, and we thank you and hope you stay connected in our retirement system family for some time to come. On behalf of the board, it is my honor to present you a certificate of appreciation for your service to the board, signed by your fellow board members. The crowd goes wild at this point. So. Thank you very much. Here you go. Okay, thank you, Charlie. Oh, by the way, we'd like to have a picture at the end of the meeting, so if everybody could stay, and we'll make sure we get Charlie's mug shot for our records. So moving on to Section 3, public comment. Rosie, do we have any public comment today?
No, Mr. President, we do not have any public comment for this meeting today.
So let's move on to Section 4, approval of consent agenda items, which, as per usual, are service requirements, deferred option plan drop entries, deferred retirement option plan drop retirements, and the training program itself. So may I have a motion and a second for the consent agenda items A through D, please? So we've got moved by Thomas Battaglia and seconded by Lou Maggi. Thank you very much. Rosie, I'm supposed to ask you if we have a motion and a second.
Yeah, yes, Mr. President, we have a first motion by Thomas Battaglia and a second by Louis Maggi.
Okay. So let's please move the vote. Can you please call the roll? Oh, I'm sorry. Everybody voted. Sorry. I haven't had my coffee this morning. Rosie?
And with that, Mr. President, this motion passes 12-0.
Thank you very much. Okay, business operations, Section 5, action items. So we have business operation action items on the agenda, starting with our first action item is the election of board president. So Greg, could you please introduce this item?
Thank you, President Kaufman. It's a pleasure to see everyone this morning. Thank you all for coming out. Before the board is an action item for the election of our board president. The board's policy titled Board's Process on Election of Board President and Appointment of Vice President provides a member of the board may serve as your president for 2 consecutive one-year terms. Our current board president, Paul Kaufman, is finishing his first-year term and is eligible to serve the board for a second-year term as your board president. Paul has served with distinction during his first term and is willing to continue his service as your board president for a second term. If it is the board's desire to have Paul continue as board president, now would be an appropriate time for a motion and a second.
Would any board member like to speak on this matter? Okay, may I have a motion and a second from the board members?
Mr. President, we have Thomas Battaglia as the first and Louis Maggi as the second, and with that, that concludes the motion moving.
Okay, I think everybody's recorded their vote. Okay, So,
So congratulations, Paul.
thank you. Thank you very much for your confidence. So, item number 2 is staff's recommendation to adopt the June 30th valuation report for the City of San Diego, the City of San Diego Unified Port District, and the San Diego Regional Airport Authority. Once again, I'd like to present our actuarial SDCERS plan actuaries, Chiron, and we'd like to ask Jean Kalwarski and Ann Harper to provide us with a summary of the report. So Jean, can you please begin when you're ready?
Good morning.
Yeah.
And, most of you probably have not met Dan. Dan is in our San Diego office, been with Chiron for more than a decade, right? And Alice, by the way, is in France. She's there until August, living and working. She thinks the school system there is better than here. She didn't say that, I said that. So we are presenting the June 30th, 2022 valuation report, but we already presented this report back in January. And because of that, and this presentation being almost identical, we're just going to hit the highlights. But I do want to mention that there is one slight change in the report that you saw in January, not in this presentation, but in the report, the count for the members in drop. In one table back in the report, table A6, the number changed by 4 people. And so there is a slight change, but it has no material effect on the valuation results. These are our typical topics. We go over history, the key and other current results, talk briefly about Prop B, and we'll be showing you a comparison of retirement systems across the country, including those in California, and we'll conclude with a look ahead. This is the timeline that you see every time we present the valuation results, and we are in that bottom highlighted reddish color, March 10th number. Typically, the valuation as of 22 is presented in January, and then in March, the board finalizes it, and then the city makes its contribution on July 1st. You've seen this historical trend before. This is showing the liabilities of the system in the bars, and then the assets are the lines. And the 2 lines, one is market value of assets, and the gold line is the smooth value of assets. And you can see how the smoothing actually is effective during down markets and up markets. But the city was nearly fully funded for years until we hit the early 2000s. And at that time frame, we had the .com, plus we had the city issues with MP1, MP2. Then there was a recovery up until 2008, and then we had the Great Recession. And if you look from 2008 on, it's a progression, but while it might not be impressive, it's really impressive in one sense. Back in 2008, you had a discount rate of 8% with weaker mortality tables. Today, you're at 6.5% with a much stronger mortality table. So if we had kept the assumptions the same, you probably would have been near the top of those bars. This is comparing what the city contributes versus what the actuarial determined contribution is. The blue bars are the actuarial computations, and the gold is what the city contributes. And since way back, the city has always contributed exactly what the actuarial computations produce. And there you see fiscal year 2024. You see that little shaded area on top of 2024. That represents the additional payments for bringing back the Prop B, which we'll discuss briefly later. Long ago, a board member who I think is no longer on the board asked, why doesn't the UAL ever decline? You know, why is it, and he had asked since 2008, why has it been increasing? And this bar chart is saying that UAL has increased by 1.66 billion since 2008. And the real reason why is the top 2 portions of that bar, the assumption changes, both economic and demographic, which together exceed the 1.656 billion. So if not for that, the UAL would have slightly declined. There you see the liability experience was a loss, as was the investment. And this is a cumulative period, not just a single year. But with the assumptions now strengthened, we see going forward that is likely not to happen, both on the liability and the investment side. Now, if anyone has any questions, I may be going faster than usual, just please interrupt me. The Port District has a similar history as the city, with the exception of back in 2000 and early 2000, they didn't have the MP1, MP2 issue, so the .com did not have, by itself, was not as major impact. But there you see the Great Recession and the steady progression since then, just like the city. And the port also, each and every year, makes its contributions. And its pattern of UAL changes since 2008 is also very similar to the city's. The airport's a little different. They have, which we'll get into later, a funding policy that requires them to be in excess of 90% funded. And there you see they have the best funded system of the three plan sponsors. They're 95%. But their pattern of UAL changes, again, is dominated by the assumption changes, both economic and demographic. And, I went the wrong direction there. And as far as contributions, the Airport Authority, you can see, because of their funding policy, actually contributes more than the ADC in many years. And that's where the gold bar exceeds the blue bar. But like the other two plan sponsors, their UAL changes is dominated by the assumption changes that have taken place. And we may get into that a little later, but we will be doing an experience study starting this summer. We'll be meeting with the board to go over that and to see whether the assumptions need any further changes. So that's the history, and then we get to the current results. And as you know, we've had at least 2, maybe 3 meetings on Prop B. It was open to new hires back in 2021, and then for non-police members in 22. And we'll show some projections at the very end that do include costs for, we call it normal costs, that's the cost of benefits being earned each year in our projections. But we will not have yet the numbers for the unfunded liability impact because we have not yet completed our analysis on Prop B. You'll see also later that the salary increases for the city were in excess of our assumed return, resulting in a liability loss. Those are the salary increases by each member group in the city. And as far as Prop B, for those new hires that came in 2021, we calculated what the missed normal cost was for fiscal year 22, and it was paid a little early in February by the city of $2.7 million. And then for the Prop B members, those that were not part of the system when the system closed, there was missed normal cost for fiscal years 23 and 24. The city made an advance payment for fiscal year 23, which we calculated originally at 35.7, but by making it early, it dropped to 34.8 because of interest. And then they'll pay the additional normal cost in this July 1st or fiscal year 24 ADC of 36.8. And then our estimate for the shortfall being the liability that these closed members brought into the system versus the monies that come in from the plans. And that being amortized over 20 years will produce an additional $10.8 million that also will be paid in fiscal year 2024. So this chart are the key results for the city. The biggest thing that stands out is the payroll and the active members, bringing in these new hires. 12.7% increase in payroll. The funded ratio in the middle portion in the gray are some important numbers. On a smooth basis, your funding ratio actually increased from 74.3 to 76. Then that's because we had some spectacular gains from the prior year that hadn't been fully recognized, and we're phasing them in. But on a pure market value, because the returns not being equal to your assumption or being less than your assumption, dropped from 82 to 77. And then the bottom portion of the chart is showing the contributions, which increased from 384 to 448, the bulk of which is the Prop B funding. And recognize that Prop B funding is an added city cost, but the city It's also saving by not having to contribute to the defined contribution plans, which is not shown in this chart. And this is the source of change. The first column is the liability, the second are the assets, and then the difference and how it relates to the ADC is the last column. But the only thing to really note on this chart is that we expected the liability to increase by $241 million, but it actually increased by 118.7. All of it, in fact, more than all of it, was due to the salary increases in excess of assumed. Some of the other assumptions actually brought it down to 118. And on the asset side, if you earned your 6.5, we'd have expected an increase of 662.7, but we earned less, and the loss was 190.6. And then the UAL is just the difference between the two. And then you see your ADC impact, which was at 400.5 before considering Prop B, then with the Prop B, we're at 448. The port adopted a floor amortization, just like the city has, and it did impact their cost this year. They also had pay increases in excess of our assumption. But if you look at the port, there's nothing really that stands out with the membership numbers on the funding ratio in the gray area. They're slightly ahead of the city, 78 to 79. And the market value is at 81.5 from 86.9, but their ADC didn't change, 19.2 and 19.2. And they had the same type of experience as the city. Liability experience loss, all attributable to salaries, and the investment loss in the second column. But at the end, their ADC remains the same. I mentioned earlier the Airport Authority has this policy to maintain a 95% funded ratio, but there's a minimum of 90, so if they fall below 90, they must contribute the amount to bring them up to 90. And then if to get to 95, they'd have to slowly increase each year to get to that 95. And I mentioned before that they've made contributions, you saw those charts, in excess of the ADC, and that's kept the funding ratio above 95%. With the airport numbers, there's nothing, well, other than the average salary did increase 6.8%, so they had high pay increases as well. And their funded ratio, you can see, went on a smooth basis, went from 94 to 96. And on a market value basis, they were at 104.1 last year. They dropped to 96.5. And then their ADC barely changed, 4.9 million to 4.94 million to 4.96. And like the city and the port, their liability experience due to salary increases produced a loss. They had the investment, so very similar to the other two plan sponsors. So that's a summary of the results. Again, I presented this previously, and now I'm going to turn over to Ann Harper. We're going to go over a comparison of SDCERS to other systems first, those across the country, and then those in California.
Good morning, everyone. Very happy to be here to present some comparisons to you. As Jean pointed out, we're going to look at different assumptions nationally and within California, and also we're going to look at some funding metrics like the funded ratio and net cash flows. This first chart here, we're looking at nationally. We're looking at a survey from the Public Plan Database. So this is all the system, not all the systems, but the major systems nationwide. There's over 200 systems in this survey. And here we're looking at discount rate trends over the last 20 years. The diamonds represent SDCERS. So you can see the trend over the last 20 years has been a lowering of the discount rate nationally. And obviously SDCERS, as Jean had said earlier, has dropped from an 8% discount rate down to a 6.5%. And over the years, SDCERS has kind of been leading the pack in lowering this discount rate. You can see that in the last 10 years, you've been in the lower 25th percentile. And in the last 5 years, you've actually were, off the charts in 2018 where no one else was at that low discount rate at 6.5, and you're still at the lowest percentile across the country. Moving on to the net cash flow rate. So net cash flows are the difference between the contributions that the plan is making and benefits and expenses that's being paid out of the plan. And the rate is just that net cash flow as a percent of your assets. So you can see here that most public sector pension plans over the decade have negative cash flows. You can see they're mostly all below that 0% on the left-hand side. And this is true because net cash flows is a measure of plan maturity, and most pension plans in this country are very, very mature. So having a net cash flow is not a bad thing. In fact, the whole purpose of having a pension plan is to being able to pre-fund your plan so that you will be able to pay out assets or benefits from your accumulated assets. So I just wanted to, note that it's not a bad thing, and it's really the purpose of having a pension plan. And it doesn't get to be an issue unless your plan is maybe around -6% of a negative cash flow. And that's when your plan becomes more vulnerable to the downsides in markets. But your investment consultants keep a close eye on the cash flows to know when they need to liquidate assets. So SDCERS is kind of at the top end of the spectrum there, higher than the median at about a -1.5%.
So just to emphasize, being high on this chart is good,
Yes.
and the prior chart being low is good.
Turning to the funded ratio comparisons, this chart is showing the funded ratio, and not on an actuarial value basis, but on a market value basis. We're normalizing this graph so that it's more consistent across all systems. So we're looking at market value and not the smooth value, because a lot of systems have different actuarial smoothing methods. And we're also normalizing the discount rate here, where they're all normalized at a 6.5% discount rate. Because if we didn't do that, SDCERS funded ratio would look lower than the other systems, because most of the other systems are higher at like a 7% or 7.5% across the last 2 years. So you can see that after 2008, SDCERS funded ratio has been improving. It has little dips here and there because of market fluctuations, because again, this is on a market value basis, but it's been improving within itself, and also relative to its peers. You can see that SDCERS is in the 50th to 75th percentile for most of the last 8 to 10 years. And 2022 is not a complete picture. It does show SDCERS funded ratio dropping, and that's because it's on a market value basis, and we all know what happened in 2022 with assets. But the bars, the distribution there is not complete. That we've only have about 1/3 of the public sector plans nationally who have reported their funded status so far. So disregard where you lie on that spectrum, because we're anticipating that you'll continue to be in that blue section, the dark blue section. Okay, so moving.
Before you begin, this is the only plan or client I've ever had that only looks at their state, so that's California.
Well, that's because we have so many systems in our state. It's almost like a microcosm, its own, yeah. So here we're looking at just California systems. And Chiron does its own survey looking at all of the caliper systems, which include the 37 counties and then all of the city systems, LA, of course, San Diego, San Francisco and San Jose, and we do throw in a couple of smaller transit plans here as well. So looking at your discount rate in California, it's a similar trend where SDCERS has been historically at the very low side, between the lowest and the 25th percentile. And in fact, again, in 2017 to 2020, you've been the lowest discount rate. Up until 2021, there are two systems that are lower than you. One is your neighbor system, San Diego Transit, a very small transit system that has been fully closed since 2012. And then the 6.25, I believe, is San Mateo. But you can see you are, at the very lowest of the discount rates in California, and that trend is moving down. So here now we're looking at the price inflation and the real rate of return distributions. And while all these other systems have been reducing their discount rate, they tend to also reduce the price inflation at the same time, which holds that real rate of return steady. San Diego has not done that, which actually makes your 6.5% discount rate even more conservative than most, because your real rate of return is 3.45% versus that ranges all the way up to 4.5%. So it's kind of another little hidden fact about the conservatism in your rate. Here we're looking at the funded ratio, again, on a market value basis. And in California, we have not normalized this. We have not changed the liabilities for the other systems to normalize it to a 6.5%. That's why you're seeing, relative to your peers in this group, that you're at the lower end of the funded ratio in that distribution. But still, you're still higher than the 25th percentile, and that's very positive given that you are at the lowest discount rate. The distribution of the funded status, the lower charts, just disregard that because that is based on a couple years ago. So apologize for the fact that that wasn't updated, but please just disregard that. So, and moving forward, I'm going to turn it back over to Gene so he can look at the projections.
Can I go back to the discount rate
Sure.
page, please? I wasn't around when we established the 6.5, and I'm looking on the slides where you show where the other counties are, the other plans with their distribution, with their discount rate.
The
In
California
California?
plans or the NASRA?
The California one.
That's what's
And so of the 37, the bulk of them are at 6.75 and above. I can't help but think about, like, what is it that they're thinking that we're not thinking, or what is it that we're thinking that they're not thinking? I'm just trying to get a sense of that.
So I can speak to this a little bit, that I think it was, in terms of the other systems, the last few years, the expected returns in their portfolio have been closer to like a 6.5% over the next 10 years. But when you look at like a 20-year or 30-year outlook, those returns look a little bit higher, closer to maybe 7%. And so the other plans tend to focus more like as an average between the long term and the short term, because that's the typical duration of your liabilities, like doing like an asset matching with your liabilities in terms of your discount rate. So I mean, and maybe Jean can speak to this. I think your board has, yeah.
If you were to look at this chart 5 years ago, maybe 8 years ago, you would still see San Diego below the others, but your rate would be 7%, everybody else would be 7.5 and above. So it's just saying that SDCERS took steps earlier than the other systems did. They were all thinking about dropping it down, but you just got there sooner.
Right.
But
yeah.
I would have said until this year or last year, it's likely it would continue, but now with inflation that has come back, it's far more uncertain what's going on going forward. But again, I mentioned earlier, we'll be doing an experience study starting this summer. and that's going to be revisited.
Right, and it's also, as you know, it's very painful in terms of the contributions to even lower your discount rate 0.25%. So the other systems have been doing it just at a slower rate. And when the experience study is done and these charts are updated for 2022 valuations, you're going to see a huge shift of that 7%. There's 9 systems that move down in 2022 alone. So where 6.75% becomes the most common discount rate.
And if we go to the NASRA one, though, it's the same thing. You could see nationally there is a drop.
Right.
Your pace of going down is faster.
I can add a little color to that as well, Louis. There was a time period where our board was looking very closely at this, and as you know, our policy now is to do an experience study once every 3 years. We were looking at our economic assumptions every year, and that was coming out of what happened, MP1, MP2, all those things that happened, making sure that we were being very cautious and that we were being very realistic. And as they mentioned, it is painful to drop your discount rate. It increases contributions for your plan sponsor. It increases contributions for your members. And so the board took that very seriously and also took advantage of years where we had earnings in excess of whatever our discount rate was. It's a little bit easier to do it in those years because you've got your investment income offsetting your lowering of your discount rate. But it was a very conscious effort by this board to be very realistic. And even recognizing, though, that it was painful to do it, they wanted to make sure that we were being realistic in our expectations. And then, as we said, once we felt like we got to a good place, then we changed our policy back to do an experience study once every 3 years and stop looking at the economic assumptions every single year.
Louis, the Boston College Retirement Research Center, they had a good study that came out, and they were looking at about 200 pension plans, and they saw that the average was 7.2% as far as their discount rate, and their expected returns on their assets were about 6.3%. I thought it was a good read. I'll send it to you. Yeah, you're welcome.
So we typically end with playing a bunch of what-ifs, which we're not going to do today. This is showing a baseline projection, but it does not include the Prop B numbers, in excess of $100 million of unfunded liability needs to be added to these charts. But we're not done yet processing the Prop B. So once we complete that, we will update this. And I know we can come back in July, we may be talking about the experience study, but we maybe have some time to show a little bit of these projections. But regardless of whether this has Prop B or not, if you look at the bottom chart, there is a cliff coming sooner or later. And
A good cliff, right?
a good cliff. Yeah. And it's looking at it right now, that gold bar drops by more than 50%. But returns going forward will greatly impact that. And one of the things we've been asked to do is to look at the way unfunded liability layers are being amortized, and that may impact the pattern of that, but that'll be part of our experience study. But again, the top bar is showing the plan. If you earn 6.5% each and every year, which you're not, it's going to be volatile, gets to 100% funding, and the same is true for each of the plan sponsors. And Port has the same kind of cliff issue as the city, and the airport doesn't because they're nearly fully funded, and so they're a little bit different than the other plan sponsors. But that concludes our formal comments, and we'd be happy to answer any other questions.
I have a question. You've mentioned this in previous presentations that the work on Prop B isn't completed, but you've given us so far no estimate of when you think that will be done. So we can really look at these types of presentations going forward on a holistic and realistic basis. We still have asterisks
Yes.
against lots of different things.
I'll
Can you give us a time frame, please?
I will turn to Marcel.
If I can jump in.
Greg.
The way I look at there's two things. One is a timing of these valuations. This valuation as of June 30th, 2022 was prior to a lot of the members joining the plan. So it's just a snapshot issue. So when we do the valuation for 2023, we'll have picked up those employees, these new people that came into the plan. So they will be in this data set. So that will be one thing that's helpful. The other is that the Prop B project is a three-phase. Phase one was getting new employees in, and that has previously happened. Phase two were people that were not hired into the plan while the plans were closed, but were still working with the city. And so that one is wrapping up. There's a couple smaller cohorts of employees that kind of missed the deadline because of changes of employment status, but we're getting those wrapped up. And the city and their representative groups are currently negotiating phase three, which would be the people that were hired while the city plans were closed, but have left the city's employment. And so when we say we're still working through the project, it's that last cohort of about 1,500 people, 1,800? Over 2,000. 2,000, sorry, over 2,000 people that we'll be addressing. And those matters will be coming back before potentially this body to say, how do we make sure that we're adequately funding the plan for that last cohort of
As I understand it, those
employees.
2,000 would have a small liability because they're people that are no longer working, right? Yeah. So they won't have any future projections going on.
So when?
So the city
Is it something that's going to get wrapped up this calendar year or not, for example?
we believe the city is aiming to have this phase three completed in this calendar year, yes.
Yeah, one more.
Jean, are you attending the retreat that's scheduled?
You have a retreat scheduled?
Oh, I guess you're not.
So if I can, oh, I'm sorry. If, the retreat will be primarily focused on board governance and our investment program governance. We will be having a experience study where we're challenging the assumptions and our methodologies, and that is scheduled to begin in July. And we'll have Jean coming in, and we'd really like to take a look at, we were looking at the trend of contributions into the plan. You know, we talked about the good cliff. And over the years, we've actually changed the shape of that cliff a couple different ways. And so we want to take a step back and look at those amortization methodologies to say, do we want to keep doing what we are doing, or do we want to do something different? And what we'd like to do is an educational session in July to start talking about just the fundamentals of how does that work, what are some of the options, what would it look like if we change some of those past decisions. And then when we get to September, that's when we would have more of the traditional investigation study where we'd look at the change and differences of experience, and the actuary would present their recommendations to change any assumptions or methodologies at that time.
And my point is, I think, Jean, it would be helpful for the board if you could show numerically the impact of the economic changes. So, for example, if you used an 8% discount rate, what would happen to the UAL? Or if you used a 5% discount rate, you know, what would happen to the UAL? Because I'm not sure that we all understand the impact of those types of changes.
Okay. So we will make sure our projection model has that feature in it where we can change those
If you,
assumptions.
that magic spreadsheet with
Yes,
the bills, the bill spreadsheet.
yes.
If you could bring that live so that you could change some of the numbers quickly.
And that'll be
so
in
that-
July, yes.
Because it's difficult, I think, for people to realize the impact of a lower investment earnings, or, why other systems are at 7.5 and we're at 6.5. So I think that
Okay.
that would be helpful for all of us. Thank you.
But I'll add to that why other systems. I know, and Ann can probably echo this, all these other systems have been thinking about and talking about lowering it to the levels you're at, but there's resistance because of the pain it causes. Excuse me.
And that's very real, and that is an issue, for all of the boards across the state. But I'm not sure that everybody understands that.
Okay.
Okay.
Anybody else?
Yeah, one question here.
go ahead.
Do we know how the Prop B, the addition of those members, is going to affect the maturity of the plan, maybe in relation to the asset leverage ratio?
Well, I think we know that they're bringing in past service liabilities of 130 million or so. But as far as maturity, the biggest measure of maturity is your negative cash flow. I mean, they're going to have some payments, but they're also going to have contributions coming in. So I don't think it's going to have a significant impact on the maturity.
So I can be clear, the experience study that you're going to be doing, when will we get the result of that?
I think it's in fall or later.
Yeah, so what we'd like to do is to do some education, some background, give the board, a background, some construct of how the actuarial process works, how some of these actuary methodologies work, and as Bobby pointed out, what are the ramifications of making some changes? And so we would like to do that in July. And so we won't be asking for any action by this board in July, but just doing education and talking about the issues.
Great.
And then come back in September and hopefully provide the actuary direction on the assumptions and methodologies.
So the retreat would be the education, no.
The
July.
education in July will actually happen at a board meeting like this.
Okay. And then the experience study will come out in the fall, and then there would be a decision made, or some sort of decision made in
Our September meeting.
September meeting?
Yeah.
Okay, thank you.
Anybody else? Okay. Jean and Ann, thank you very much. Appreciate your presentations, very nice.
Thank you.
I think we need a motion and a second from the board.
I think we have it.
What we do?
Mr. President, we have Lisa Marie Harris as our first,
okay.
seconded by Roberta
Excellent,
Spoon.
thank you. We have a motion before the board, so please record your vote. Here we go.
And with that, Mr. President, the motion passes 12-0.
Thank you very much, Rosie. So with that taken care of, we will now move on to Business Operations Action Item 3, staff recommendation to deny the request to reconsider the board's decision to deny the industrial disability retirement application of John Fry. So Mr. Fry's attorney, Mr. Cunningham, is unable to attend the meeting due to a good cause and asked for this matter to be held over once again until our May meeting. So as such, this item is being pulled from the agenda. We'll address it at next meeting. Okay. So this finishes our business operations agenda items. We'll move on to Section 6, which is the Audit Committee. So Lana Rajanko is unable to join us today, so I'm pleased to welcome Mia Horansky. Mia, there you are. And will be providing us with the Audit Committee report.
Thank you.
Yeah.
We met on Wednesday, March 8th, 2023, and I'm just going to do a readout of the meeting. We had an IT internal audit plan execution request for proposal. The Audit Committee motion to direct the CEO to select outside firms to execute IT internal audits over the next 5 years for an amount not to exceed $100,000 per year. This was approved by all committee members present, vote of 3-0. Roberta Spoon will be discussing this item in her B&G report out, and the committee will have an opportunity to vote on this motion at that time. We had one information item, proposed November Audit Committee meeting date change. Sarah Dixon discussed how the November 15, 2023 Audit Committee meeting will be pushed to November 17, 2023. This will allow staff more time to ensure compliance with the Brown Act. We had 3 reports. In the Internal Audit Division report, Sarah Dixon provided a status update on the Port District's remediation efforts. We had an Information Technology Division report. Michelle Wegner-Malecki provided an IT update. And then we had the Benefits Administration Division report. Marcel Voorhees Rossman provided a Prop B update. And then during comments and questions, Greg highlighted that SDCERS phishing program is working well. We're happy to hear that. And the next audit committee meeting is scheduled on July 12th, 2023.
Thank you very much, Mia. Thank you very much for being the Audit Committee Chair, interim chair at this point. And we're going to move on to Section 7, Disability Committee. So I'd like to announce Charlie Hawkins' final report.
Good morning, everybody. Yesterday, we actually almost set a record with having a short disability meeting. We had a very small agenda. We did have two staff recommendations to approve industrial disability retirements, one for Damon Stebiers and the other one was for Chris Willett. Both of those passed unanimously in the committee, so we'll move those for the consent items.
Thank you very much, Charlie. We're going to miss your clear and concise reports, and we're going to move on to section.
We need to vote.
Oh, I'm sorry, we didn't vote.
Yes.
Sorry. So we need we've moved by Roberta. And if you guys could please vote.
And with that, the motion passes 12-0.
Okay, and I had one last comment, just to let everybody know, if you looked at the disability report, we're starting to see some more interest in people applying for disability retirements. We're still doing very well in processing them time-wise. The only delay our staff is seeing is there's a delay in getting the medical reports back, but the doctors and everybody else have been working diligently. The reports are complete. So as of right now, we are in very, very good shape going forward to the future.
Thank you, Charlie. Let's move on to Section 8, Business and Governance Committees. Bobby, could you please provide your committee report?
Certainly. The Business and Governance Committee met yesterday, and we had 4 action items, and they were all approved by the committee, and they are on the consent agenda today. Are there any of the action items on the consent agenda that any member would like pulled? Great. So I will start with the consent agenda. Number 1 was staff's recommendation to approve the results of the 2023 active police safety board member and retiree board member elections, and it was presented by Jessica Taylor. The committee approved the results of the 2023 active police safety board member and retiree board member elections, certifying Lou Maggi, congratulations, and active police safety board member Chris Brewster. Is Chris here? Yes, there he is, as the new retiree board member. And we will welcome you at the next meeting. That's right, at the next meeting, okay. Number 2 was staff's recommendation to approve SDCERS action plan for fiscal year ending June 30, 2024, and that was presented by Greg. The committee approved the fiscal year 2024 action plan. The action plan is updated every year to include projects above and beyond the regular daily business operations in an effort to find new ways to improve how we serve our members, protect the trust, and strengthen our governance. The action plan is a living document in that it can be amended for newly identified critical projections during the year. And it's very detailed, and it's in the board packet, and I encourage you all to take a look at it. There was a lot of work that went into it, and keep in mind that it's for tasks that are in addition to the daily work of the agency. It's really overwhelming. There's a lot going on, and I congratulate all of you on getting what you get done. Number 3, staff's recommendation to approve SDCERS administrative budget for fiscal year ending June 30, 2024. Ted LaSalvia again presented the most perfect budget ever. The committee approved the SDCERS fiscal year 2024 administrative budget of $17.1 million. Our Ted highlighted how the majority of the budget is labor costs and the city negotiated pay increases recently approved and anticipated city pay increases during the coming year are the primary reason for the 2.8% increase in the total budget. And keep in mind that that is much less than inflation, so they've really done an excellent job. And there were pay raises that were included from the 2022 budget that were not included last year or not known and included. So really the pay increases included 2022 and 2023 pay increases. And they managed here to keep that total increase to 2.8%, which is remarkable. And Ted is amazing. Ted is just an amazing CFO, so we're really very pleased to have you in charge of all of this. Number 4, the IT internal audit plan execution request for proposal was presented by Sarah Dixon, and that was mentioned in the audit report. Sarah presented this item, which is the same item that was presented to the audit committee. Both the audit committee and the B&G committee approved delegating the authority to the CEO to select outside firms to execute the IT audits over the next 5 fiscal years, beginning in 2024, for an amount not to exceed $100,000 per year. It's very complicated. Just take a look at what's in that packet and you will see why it needs to be outsourced. Number 5, staff's recommendation to review and amend the board process for various policies and board rules. They're in the packet. We had no changes and we voted unanimously to adopt Johnny's proposal to amend these documents. So I move the consent agenda items 1 through 5. How do I do that? Okay. And now we can vote. Is everybody in?
We're still missing 1 vote.
There we go.
And with that, Madam Chair, the motion passes 12-0.
Great, thank you, Rosie. We heard oral reports from Cynthia Queen, Member Services, from Marcel, from Benefits Administration, and Michelle from IT, and written reports from Legal and Compliance, Johnny. Finance from Ted. Ted produced finance, financial statements, and budget reports. Are there any questions? If not, I turn it back to you, Paul.
How long was your meeting?
It was about 45 minutes.
Bobby, thank you very much for your committee report. We're going to move on to Section 9, Investment Committee. So, Mr. Clifford Shearson, excuse me, would you please provide your report?
Happy to. Thank you, Mr. Chairman. The Investment Committee of SDCERS met yesterday afternoon, and it was a lot longer than 45 minutes. The committee was in full attendance. We had 2 action items and 4 information items. The first action item was to approve a manager selection for a return-seeking fixed income allocation, and that was approved unanimously. Corinna and Anders, maybe you could provide the whole board with some background.
Be glad to. Good morning, everyone. So as Cliff noted, we had a lengthy meeting yesterday. We interviewed 5 investment managers. To provide a little bit of context, we're talking about our return-seeking fixed income portfolio, which is about 5% allocation of the total fund in our target asset allocation. And just to make sure I spell it out, so these MAC strategies, as we'll refer to, those are multi-asset credit strategies, and they invest in a number of underlying sectors within the fixed income market, including high yield, bank loans, emerging market debt, and other subsectors. In this particular asset class, There is a focus on obviously generating yield, but importantly protecting the downside in case you do experience a default. So one metric that we did focus on was max drawdown, and you'll see that in our portfolio combinations that we review in the materials. So just again, it's really difficult to recoup capital losses. And so we've also focused on credit quality. We are not necessarily recommending of all the allocations that we analyze the highest yielding portfolio, because that particular combination would have had more exposure to CCC rated names and unrated securities. So we've been very cognizant about the amount of credit quality and risk that we're undertaking when we are recommending this slate of managers. I will have some concluding comments as well, but at this point I'm going to pass it over to Anders.
Thanks, Karina. Good morning, everyone. So I thought it would be helpful before we get into the process to kind of understand where the return-seeking fixed income allocation sits within the portfolio in terms of risk level. So the return-seeking fixed income allocation, as the name implies, sits within the return-seeking portion of the portfolio due to its higher focus on capital appreciation as compared to the US or domestic fixed income allocation that sits within our risk-reducing assets, and which main goal really is to kind of reduce the risk and combat a little bit of the equity risk that we have in the portfolio. We currently, in the return-seeking fixed income allocation, have 3 emerging market debt managers. All 3 of those would be terminated, and the proceeds from that will be redirected to the 5 multi-asset credit managers, and then the kind of, what do you call it, the remaining funds needed to get, I guess, the target would come from SDCERS's cash position. If we look a little bit at the search process that we went through to get to these 5 managers that we're recommending today, we started with about 160 managers in the universe, and this was narrowed down to 21 using Aon's buy-rated manager list, and as well as input from staff. And using this 21 manager universe, staff asked the consultant Aon to create different portfolio combinations, and these combinations were selected to test the effect of various scenarios where we added different weights to different managers. At the same time as we were analyzing these portfolio combinations, staff also sent out due diligence questionnaires to all the identified multi-asset credit managers with a broad set of questions that we wanted to have answered by them. So after we analyzed the combinations in of the portfolios, as well as the due diligence questionnaires, we were able to narrow down the field from the 21 down to the final 10 candidates, which we conducted on-site due diligence visits on. And based on the results of these visits, we were then able to further narrow down the field to the final 5 candidates that presented yesterday. And we felt that these 5 managers that presented yesterday were the best possible combination going forward, and that would yield the best portfolio combinations or characteristics, as we should say, that Karina kind of went through a little bit earlier. I'm not going to go through every single slide here, but just kind of maybe land on the last slide. Although all of these 5 managers use some form of kind of top-down, bottom-up investment framework, they all brought some specific advantage to the allocation. So, for example, Apollo's Total Return Fund, they've historically generated fairly stable returns and provide broad universe coverage with some private credit exposure in their portfolio. Ares, which is the second one, provides a strong exposure to bank loans, high yield credit, as well as the CLO market through their large credit platform. And Guggenheim is the most conservative manager in the allocation and is especially focused on structured credits like asset-backed securities and mortgage-backed securities, and they also have a higher credit bias within their portfolio. And the PIMCO and Wellington both have obviously vast resources at their beck and call through their credit research platform. They both provide also a broad market coverage to the multi-asset credit universe through their diversified approach, but they also use significant exposure to emerging market debt, which differentiates from the other three managers. So to conclude, what we're asking is the board to approve the recommended portfolio structure, which, as we see on this slide, includes 25% to the Apollo Total Return Fund, 20% to the Ares Global Multi-Asset Credit Strategy, 15% to Guggenheim's Multi-Credit Strategy, and 20% to each to PIMCO's Diversified Income and the Wellington Multi-Sector Credits allocation. Together, we feel that these managers form a well-diversified portfolio with broad exposure to the multi-asset credit universe and especially low correlation of excess return to each other. So when one zigs, the other one will zag, so that there's no kind of ebb and flow within the portfolio returns. And we think that that's beneficial from a diversification standpoint. So with that, I'll hand it over to Karina for some concluding remarks on this. Are there any questions?
Yes, thanks, Anders. So just philosophically, the committee decided some time ago to migrate away from dedicated emerging market debt mandates that we currently have with 3 managers to invest more broadly in these max strategies. And these are go-anywhere strategies, but each manager has specific expertise. This particular type of portfolio construction gives SDCERS the added benefit of opportunity to add alpha through tactical asset allocation in making relative value decisions across these sectors. Another approach would have been to hire, for example, 2 high-yield managers, 2 bank loan managers, 2 emerging market debt managers, and manage that to static allocations. But again, that would have really narrowed the universe. It would have not allowed us to participate in out-of-benchmark opportunities, and it would have also, in a static asset allocation, you're not getting the benefit of being able to add value through tactical asset allocation. So as Anders noted, the managers have specific areas of expertise. Ares, Apollo, Guggenheim, very focused on structured credit, and that helps to diversify our risk. That is less correlated to credit than, for example, high yield, and that's, again, reducing our overall risk. As Anders noted as well, with PIMCO and Wellington, these are very large firms with breadth of opportunities and research capabilities, including emerging market debt. And that helps reduce the tracking error to our policy benchmark. I would say that Apollo is a very unique strategy. It's a hybrid interval strategy that also invests opportunistically in private opportunities, and they're able to take advantage of uncorrelated sources of alpha, for example, in music royalties, aircraft leases, and soccer league contracts, to name a few. Ares, again, as Anders noted, here you have some exposure to CLO market, and they are able to leverage their large origination platform for that deal flow. PIMCO, definitely a top-down manager. They have secular forums where they're able to develop their macro views and express throughout their products. Wellington, you see career analysts, extremely expert in their fields, and they have deep research benches. And we're able to leverage that in this particular portfolio combination that we're recommending. I would say all firms have a focus on ESG, and you see this in varying ways. When you look at Wellington, here you have a CEO at the top of the organization. PIMCO is producing now annual D&I reports, so that's an increased level of transparency. The managers are also supporting local communities and creating recruiting pipelines to really increase underrepresented communities. So while they all have made impressive strides in these areas, they all recognize that more can be done. In summary, we believe that the recommended portfolio will reduce our exposure to equity and also leverage diversity of approach, expertise, and thought. We are confident that the portfolio we've structured is a robust combination of top-tier managers with demonstrated ability to tactically asset allocate and mitigate downside risk. And with that, we'll take any questions.
If I may, this is for how much money?
This is for 5% of the total fund. It's a roughly $523 million, depending on the day.
I just had a comment, just for the edification of the board members that weren't at the meeting. Can you go through how this is not, it is deviating from the policy, but it'll be revisited when Aon comes back to look at our overall policy?
Well, I would say that in this particular area, when we look at MAC, again, some strategies were more focused on high yield or bank loans, while other strategies were broader and included an allocation to emerging market debt. Our policy does include an allocation to emerging market debt as well, but these are really, like, for example, in Wellington's case, it's a reference benchmark. It allows the manager to have latitude to invest in out-of-benchmark opportunities. We, at the outset, in making this portfolio recommendation, are not anticipating a policy change, but rather part of the beauty of this allocation is that we are outsourcing the decision to the investment managers that are in the market day-to-day to make those relative value decisions and to provide SDCERS with a broad opportunity set. This broader opportunity set drives the risk-adjusted returns possible with the portfolio. And again, this is superior to had we developed a portfolio of just static allocations in set asset classes. It widens the opportunity set to create value for the plan.
I just want to add to the DEI conversation. So a number of us had questions for the managers around their DEI policies. I do want to recognize Lisa Marie for being very strong on that point across all the managers. I found on many of their answers to be very boilerplate, to be expected, I suppose. What I would love to do, what I would love to see is a tracking of the progression of their, of how they do. I imagine we won't see them again in front of us for another 18 months, 2 years. I just hope they don't come back with the same platitudes, and so to the degree that we can track, not just these managers, but all of our managers, to keep them honest in what they're saying, so that would be wonderful to see.
Yes, and we do report annually to the board on our integration of ESG. We're working to come back to you with how that is expressed through our private investments. And we most recently updated this, I think, in our November meeting for the public markets. So it is something that we revisit annually.
Mechanically, we have to take a number of votes, right?
We do.
Yes. So
We
just
have
to explain to people, we have to approve, we have to have a vote, excuse me, where when we hope we will approve the program. And then we have separate votes on each of the 5 underlying managers that are part of the, we call it the portfolio of portfolio managers that staff and consultant have worked so hard to identify and develop and kind of balance thither and yon. So one at a time. Get a lot of practice.
And Mr. Chair, with all votes in, this motion passes 12-0.
Thank you, Rosie. Now we're going to have a vote on Apollo.
And once again, with all votes in, Mr. Chair, this motion passes 12-0.
Thank you. And Aries. Okay.
And again, this motion passes 12-0, Mr. Chair. And with all votes in, this motion passes 12-0, Mr. Chair.
Thank you.
With all votes in, this motion passes 12-0. And with all votes in, the motion passes 12-0, Mr. Chair.
Thank you.
Thank you.
We have one more?
That was the final motion.
That was Wellington. Okay, the name go. So, we have the next action item. It is confusing. We had a long meeting. So, the second action item is much less complicated than the first. And it was to approve State Street's performance measurement services for our private market investments. And let's focus on State Street and private markets. This item was discussed at length by the committee yesterday afternoon, and the vote was unanimous to approve. With that background, Jamie, maybe you could share with the board some of your comments and perspective, please.
Absolutely. And before I get into the actual item, I wanted to just give you a little bit of backdrop. You saw on the agenda, there are two different items. One's an informational item, one is an action item. And I wanted to provide a little bit of backdrop on what the differentiating factor is between them. In this case, this is performance for private market investments. Due to the dollar size, this does require a board vote. For the other portion, it is for core performance services. That's really relating to like total fund performance. And due to the dollar amount for that, that falls within the CEO's discretion. But in an abundance of transparency, we wanted to make sure we reported out to the board that State Street would be engaged for that service. So moving back to this item, so currently in private markets, SDCERS is reliant on its real estate consultant and private markets advisors to calculate and report performance for real estate, private equity, and infrastructure. The performance and related information is not verified by any outside party. SDCERS does not have an integrated system that combines this information at the private markets portfolio level. Currently, staff is manually collecting information and combining the private equity and infrastructure information that is provided to the board on a quarterly basis. And we'll touch upon the services that fall within this module in a minute. Let's move on to this slide, and this is really showing the current reporting structure, starting at the bottom, really. You can see Makita, GCM Grosvenor, and Stepstone. Those are performance reports that you currently receive. And those performance reports are sent to the board, and that performance is also sent to Aon, and they use that information to calculate performance for the total fund. Now, if we look at this next slide, this is showing what the new structure would look like. As you can see, there is a new node added in the top left quadrant, and that's for the private markets performance. The performance and related information would be calculated independently from Makita, GCM Grosvenor, and Stepstone. However, those three entities will continue to provide information directly to the board, as you're currently familiar with, but staff will have the capability to verify the returns provided. So let's look at what the services that State Street could offer us are. Let's start first. State Street, as the custodian, is uniquely positioned to assist SDCERS with performance measurement services. They have access to all of the transactional and market value information. And with that, they are able to provide the private markets performance and commitment tracking for each limited partnership investment within the portfolio, and that includes the underlying limited partnership investments in the GCM Grosvenor and Stepstone portfolios. They'll be able to provide pacing analysis with the ability to prepare combined views. This would enhance SDCERS' current model,
where the two advisors' information is being manually combined by staff using each advisor's data and assumptions. They'll be able to provide more robust fee information from a single source, and this would also be an enhancement to our current process where staff is manually collecting information from the real estate consultant and advisors and combining it to fulfill our reporting requirement for AB 2833, which is now known as California Government Code 7514.7, which you receive in November of each year. And then finally, diversification information. This will be provided by geography, investment type, vintage year, and strategy, and it'll give us the ability to combine that data and also look at it on an asset class level. So the question becomes, how much will this cost? Well, as you can see, the services that I just went through are listed here. And based on SDCERS' longstanding relationship with State Street, the combined annual fee for these services is $114,350. It sounds like a lot, but there are some competitive advantages that State Street has in providing these services. We did talk to other custodians, and really there's no good option on having an outside custodian provide these services. So for State Street to provide this, it would be an add-on service. It's as simple as them turning it on and us working with them to make sure that all of our data is properly loaded into their system. It wouldn't be necessary to switch to another custodian. That is an arduous, timely process and not a decision to be taken lightly. So this service would be easier for State Street to implement. Secondly, State Street is our current custodian, and they have our history. They've been our custodian since 1998, so they have a great wealth of institutional knowledge about SDCERS. And then finally, with fees. In talking to the other custodians, while we weren't able to get a detailed fee proposal from them, what we were able to determine is that the way that State Street calculated the fees using a limited partnership, a per limited partnership model in calculating those fees is consistent across the other custodians. So what that did is it gave us confidence in the fee that was proposed to SDCERS. So then finally, what are the benefits? The addition of these services would benefit SDCERS by providing the capability to verify performance, and this would really just give us additional confidence in the performance that's reported on a quarterly basis. It would deliver robust information on the private markets portfolios to analyze exposures, performance, and fees within those portfolios. And finally, we would have the ability to analyze cash flows to develop better pacing models rather than just relying on the consultant and advisor's pacing models. So staff believes that the addition of these services is prudent and will help to align SDCERS with industry best practices. And with that, I will stop and see if there are any questions that I can answer.
Jamie, one quick question. The total fee, do you know what percentage that is of the portfolio that they're analyzing, roughly?
My spot math. No, I need help. I need help. The percentage of the...
Thank you. Yeah, I think you can disclose the custodial annual amount, but obviously State Street is not managing assets. It's not one of our investment managers.
So the current custodial fee is $197,000. This fee is $114,000, as I mentioned, and yes, it is it'll be an add-on to that $197,000. But it's because of the number of limited partnerships.
So that's about $300,000 worth of management fees. What's the portfolio value that they're looking at?
It would be about $1.5 billion for private markets. And so the number, let me break it out into the number of limited partnerships.
Yeah.
So we have 43 limited partnerships just within our purview. Then if you look at GCM Grosvenor and Stepstone, which are included in that 43, and you break those down, that's 189 limited partnerships that State Street will be providing performance on. So that's the reason that the cost really grew exponentially in the proposal.
Okay.
Did I see a question over here?
If I may, it's a linear growth. rather than exponential.
Yes,
You
exactly.
add,
Yes,
you add
thank
20
you.
funds down the road, the fee will go up by 20 units,
Yes,
right?
exactly.
Thank you.
Sure.
Rosie? You think we have a motion? Now we can vote.
And Mr. Chair, with all votes in, this motion passes 12-0.
Thank you very much. We have four, I think, very interesting, I hope for everybody, information items. And we'll go first with a discussion of an investment operations risk assessment. And we'll ask Demetrius and Anders to talk with us a bit more about their work. And while they come up to the table, SDCERS conducts an investment program risk assessment every 3 to 5 years to examine the operational risks related to managing the investment program. This involves identifying the operational risks and the risk controls that SDCERS has in place, evaluating the efficiency of the controls, and implementing enhancements to the risk controls where necessary. Staff made several enhancements as a result of this year's assessment, including the addition of investment software to monitor portfolio exposures and the addition of State Street's performance measurement services. Gentlemen.
I think you took the thunder there, but I'll hand it over to Demetrius then to go through the four-step methodology.
You summarized the process pretty well. I think the only additional comments I have are this item and the next information item, the best practices review, are really a two-pronged approach to looking at what the investment division is doing and making sure that the controls that we have in place and the processes and policies we have in place are best in class. So this item is an internal assessment. The next item is an external assessment.
Thank you. I apologize.
Just made our job so much easier. Thank you.
Okay, well, very good. Then for the next item on investment best practices review, Jamie, please.
And Demetrius totally teed it up perfectly for me. So as we discussed, the best practices review is part of the fiscal year 2023 action plan. And what this is doing, it is looking at the investment program's effectiveness and efficiency. And to do this, we're going to use an outside consultant. We did conduct an RFI. We had 3 respondents to that. After reviewing those RFIs, request for information, excuse me, and once we reviewed those responses and we talked to those vendors, we really came to the conclusion that a firm by the name of Curcio Webb is best positioned to conduct this review of the investment program. Curcio Webb is an independent consulting firm that has been providing consulting services since 1999. They're 100% employee-owned, and they continue to allow more employees to have company ownership. They're certified as a women-owned business and have a strong focus on diversity within the company. The proposed team is very strong, and they have a lot of experience within this area. They have conducted over 60 similar reviews over the past 3 years. The fee that was proposed was extremely competitive, and it was also the lowest of the 3. They've proposed a fee of $50,000. SDCERS contracting policy gives discretion to the CEO to select and contract with a provider if the cost of the contract is under $50,000. Staff is currently negotiating with Curcio Webb, and assuming that those negotiations are successful, staff intends to proceed with Curcio Webb as the selected consultant for the best practices review. With that, I'd be happy to answer any questions that you have.
So, as we heard, this is the first time SDCERS
Exactly.
is undertaking this project. Has there been, with everything else going on, any discussion of whether this may become something that is done on a more regularly scheduled and periodic basis?
There have not been any discussions, but I mean, would make sense that perhaps this would be something that would be conducted on a periodic basis.
Okay. We look forward to hearing about the results of the work.
Absolutely. Thank you.
Thank you. You're up next for information item number 3 on the core performance measurement services, Jamie?
Yes. So you got to hear me talk earlier about the action item. And for this item, this is really dealing with the core performance services. And this also falls within the CEO's discretion, as the fee for this service came in at $49,000. It was heavily negotiated with State Street. And what these services are doing is they're providing the performance on the total fund level. And there are several things that it's going to provide. It's going to provide the performance measurement. It'll provide peer analytics. It'll provide risk statistics. It will also provide market data that we'll be using to construct the benchmarks, and also a customized benchmark similar to or consistent what is within the investment policy statement. So with that, actually, I guess I should say one other point to mention is that Aon currently provides your total fund performance. That will not change. They will continue to provide that. This is really just a double check on that, and it'll give staff the capability to really look into those returns and see how, if they are consistent. And also, we only receive those return information on a quarterly basis. This will give us the ability to receive it on a monthly basis from the custodian. And with that, I can answer any questions that you have.
Thank you very much.
Thank you.
And then to get a sense of where we're headed, we also have to know where we've been. And so the fourth information item from Anders would be a discussion on the Aon total fund performance for the quarter ended December 31, 2022.
Thank you, Cliff. So what was a very gloomy year had a little bit of a nice finish to it. So the fourth quarter, we ended with 4.5% of positive performance, which slightly underperformed the market's 5.4% return. This underperformance was driven mostly by the Opportunity Fund, which typically lags when stocks and bonds do really well. So it's more considered to be a diversifier within the portfolio and won't keep up when stock markets do really well. On the other hand, it will do much better than the stock markets when they do really poorly. So the year was also, although we ended the year negative, we outperformed the markets. We were down 7% and the markets were down 9.3%. So we outperformed by 2.3. The outperformance in 2020 came in mainly from the Opportunity Fund, as I mentioned. When the stock market does poorly, Opportunity Fund tends to outperform. On a longer term basis, on the 5 and 10 year, the total fund has outperformed its policy benchmark and ranks in the top quartile compared to other large public pension plans, and while taking on a lot less risk than those pension plans. Asset class performance over the longer term time period also remains very strong, with all asset classes currently outperforming their respective policy benchmarks since the inception of each of those asset classes. So with that, if there are any questions, I'd be happy to take them.
Thank you very much.
Right. Thank you.
Mr. Chair, this concludes our report. Thank you.
Thank you, Cliff, for the investment committee report. We're going to move on to section 10. Questions and answers. Questions and comments. Sorry. Again, thank you, Cliff, for your investment committee report. We're going to move on to section 10, which is questions and comments. I'm going to start off by congratulating Lou Maggi and thanking him for his continued board service for another 4-year term. Cliff, thank you very much. And I'd like to welcome Chris Brewster. Is Chris here in the back? There he is.
I stuck around for
All right. Thank you. Welcome to the Board of Administration as a retiree member. And Chris has already begun his onboarding and will be hopefully joining us at the April 14th board meeting coming up shortly, so congratulations to both of you folks. Do we have any other questions from the board members in general? Natasha?
I just want to say thank you to the investment committee for going through those hours of presentations on our behalf. So appreciate it.
I would like to say thank you to Charlie. Charlie, you've been amazing, and thank you for your guidance and your wisdom and all of your wonderful stories that we're going to miss, and for your service. You're the only one that has had 2 rounds of this, and that experience just can't be replaced. So you really are not replaceable. And I'd like to thank you.
For what?
For signing up for another year.
Thank you. Do we have any comments or questions from the staff in general? Oh, sorry.
Greg, can you just run through the agenda for the retreat so that everybody has an expectation of what we're going to be seeing?
Absolutely. So we'll be meeting on April 14th over at the University Club. We'll be meeting on April 14th over at the University Club, and it will be starting at 8:30 in the morning. There will be a kind of refreshments and networking before the meeting, so there'll be something for you there, some coffee and things. But we'll be talking about board governance. We'll be looking at what skills, kind of an easy way to say it is, what is our job and what skills do we need? So we'll be looking at kind of a skill assessment at a board level and also for the various committees. But the bulk of the day really will be focusing on our investment program. And this really has to do with the feedback that the board provided through the survey that we took last year that really focused not only the investment committee members, because I knew they would be excited about investments, but the non-investment committee board members also said, we'd like to really focus on investments. And so that's where the bulk of our day will be looking at. And I really enjoyed working with Karina as we crafted this agenda along with the board's ad hoc committee. And it really starting at the very top of looking at our investment program as what are the top policy decisions, and as the day goes on, getting further and further in actually the structure of the program and actually how we affect that. Ending up the day of the investment portion and looking at just some overview of the various asset classes. So starting at a very high policy level and going down more granular. How'd I do, Karina?
Excellently.
Perfect. Yeah.
Yes. We're looking forward to a great day.
And we're going to wrap up the day talking a little bit about the education program. I've heard, and when we did the survey of what the board wanted to talk about, I kind of floated that out there with regards to education, and there was some really good feedback on maybe tweaking a little bit how we look at educational conferences, how we approve them, how we give feedback to the board on the quality of those educational items. So it'll be a very short item, but I think a very important item at the very end of the day.
And will we get an agenda with the speakers so we see what's the exact agenda?
Yes, we will. We'll be sending out an agenda along with board materials. So similar to where we provide materials in advance of a regularly scheduled board meeting, this special board meeting, and it is a special board meeting, we'll have advanced materials provided.
Charlie, you want to say something?
Yeah, I just wanted to say goodbye, but more importantly, I wanted to thank the staff for doing such a great job to take care of us retirees. It was my honor and privilege to work with you guys, and I can speak on all the retirees that they do appreciate what you do. Even though you only hear the ones that complain from time to time, for the most part, everybody is really appreciative. They understand the sacrifices that you're making, and it's really important for us that you do know that we do appreciate you. And I say the same thing to everybody on the board. Thank you for serving and helping us do it. And just so you know, my last story, when I got hired by the police department in 1978, the plan was I was going to retire at age 50, and back then the actuary said I was going to be dead at 53. Okay? 2 weeks ago, I turned 68, and I've been retired now from the city, going on 16 and a half years. So I've beat all the charts, and I beat all the numbers, and I'll be here a lot longer. Thank you.
And that is why we have a deficit. And that's the story of the unfunded liability.
It's all due to Charlie. Thank you, Charlie. One last announcement, closing remarks from my fellow board members. If you are interested in taking Charlie's chairmanship position, please either email me or ask to have your name put in the pot, and we'll make a decision shortly on the accumulated pool of talent. I already do have one person that's interested, and if anybody else is interested as well, please let me know. So one last thing, please remember, please stay here for a picture opportunity, photo op with Charlie after the meeting. So Johnny, are there any matters to discuss in closed session this time?
No, we don't have any closed session planned.
Excellent, okay. So Johnny, thank you. We'll move on to section 13, which is adjournment. So I'd like to adjourn the meeting. Our next meeting will be a special meeting of the board held on April 14th at the University Club, as mentioned by Greg earlier. Our next regularly scheduled board meeting will be held on May 12th here in the SDC boardroom at 401 A Street. I would like to remind the board members to remain for the photograph. Thank you very much. We are adjourned.